Good evening, everyone. How are you? For those of you that may not know me, my name is Shanita Jones. I am a certified public accountant, and I am the proud owner of Jones Taxes and Financial Services, where we specialize in child care, accounting, and tax. So, with tax season being underway, tax is a hot topic around here right now. There's tax season, tax planning, tax preparation, tax forms, tax statements to families, tax readiness. By the way, we're having our second child care tax readiness webinar this coming Sunday at 4 p.m. But one of the topics that has come up the most is credit cards and how credit card payments should be treated. I could not think of any other way to explain this to a group of educators such as yourself, except but to put my educator hat on. So, today's topic, ladies and gentlemen, is going to be on credit cards. Now, I count, I don't spell, and my penmanship is not good. Please do not judge me harshly. So, credit cards. Credit cards affect two parts of your financial statement. Your businesses are based on two primary financial statements. You have your income statement, also known as the profit and loss, also known as the P&L, statement of cash income and disbursements. It's a lot of names that are used synonymously for the income statement, and none of them are incorrect. And if you are in a nonprofit situation, you know even more terms. The second important statement you have is the balance sheet. And just to keep these straight, we're going to give it another color. So we have our balance sheet. Our income statement tells us about our revenues, that's our money coming in, and our expenses, that's our money going out. Oops, told y'all. Expenses. Okay. Okay, expenses, that's our money coming out. Once you have our money coming in, our money coming out, the difference is our net income. And in a very simple world, this net income is the amount you're going to be taxed on. Now, the income statement is for a period of time. It might be for the month of January. It might be for the year of 2019. It might be for the first quarter. It might be for a period of time. Now, once that period of time is over, usually a year, a calendar year or a fiscal year, once that period of time is over, this income statement gets closed out and this net income amount comes over to our balance sheet. And when it comes to our balance sheet, it sits in an account, a retained earnings account. Retained earnings is an equity account. Equity, of course, is what you have left in your business once it's said and done. Okay? So, when we say equity, if you are in an S corporation, C corporation situation, this equity section is a little different, but I'm trying to keep it very simple. So we have our income statement. Our money came in, our money came out. The year was over, and this is our net income. This is the amount of money that we're going to be taxed on. This net income amount is going to move over to our balance sheet. So all year long, the expenses that we paid money for, it came over to our balance sheet when that year got closed out. By the way, if you are a client of Jones Taxes and Financial Statements, your statements are closed out because you're rocky, you're great, or we're having a little bit of trouble, but we're working on it, especially some of our newer folks. So now we got our balance sheet. What's a balance sheet? Your balance sheet tells the health of your business. And on your balance sheet, it consists of three major sections. You have assets, you have liabilities, and you have equity. These are your three primary parts of your balance sheet. Yeah, and it's split in half, sort of. So the sum of your assets and your liabilities must equal your equity. Well, what's assets, Shanita? Assets is cash. assets are accounts receivable. If you have inventory, assets are inventory or the products that you're going to sell. If you own land or buildings, these are your assets. Liabilities. We went through all of this to get to the liabilities. Credit cards, ladies and gentlemen, are liabilities. When you spend money on this credit card, two things happen in the accounting world. See, in your world, what happens is you spend the money on your credit card, you get what you want, life is good. But over here at Jones Taxes and Financial Services, some other things are happening. And I'm going to switch sides a little bit so you can see the board. Okay, we started out income statement, one of our primary statements, and the balance sheet. These two were not the same thing, but I'm getting a lot of stuff coming over from a lot of people. They say they're professionals, and I'm seeing beginning balances on income statements that should not be so. By the way, if you have an accounting system or a bookkeeping system in place and you are not sure if it's good, we offer diagnostic review services. You can either you can get a written report and we will give you a checkpoint list of what's wrong, what needs to be fixed, and if you are unable or unwilling to fix it yourself, we will fix it for you. And it's called a QBO checkup, QuickBooks Online checkup. Back to the matter at hand. So these credit cards are liabilities. When you go on that credit card and you buy some cubbies, what happens is money goes in $50. It goes into your expenses. So now that's $50 you get to deduct on your tax return. But the other thing that happens is $50 increases on your liabilities. And this is the money that you owe. So when you go to pay this credit card statement, we've already taken the expense here, right? We've already deducted our $50. So if we started out with $100 in parent payments and then we spent $50 on cubbies, we have net income of $50. That was a really bad year. And then at the end of the year, this $50 went into our retained earnings. So now when we start the new year out, we had $50 in retained earnings. But remember when I told you that assets and liabilities together had to equal your equity? Well, we didn't mention any assets in our example. Our liabilities are $50, right? Because we owe $50 on that credit card bill. And our retained earnings had $50 because that's what moved over, right? Right. It's just too simple to be true. So now, when I go to pay this credit card statement, let's say this happened in December, and now I'm in January. So now this is January 2020, and I want to pay this credit card bill. What do I need to do? Well, I'm going to make my liabilities go away. So that $50, when I pay it, it's going to go away. It's going to be zero, right? When that zero goes away, it's also going to have to come out of cash. So that's also going to be a negative $50. That's going to be zero. Some things had to happen all month for me to make money, and then that will roll up into retained earnings. But the main situation that we're looking at right here is this credit card situation. This is a liability. When you pay that credit card bill, you started out, you had a balance, you spent $50, right? And then when you paid it, 50 minus 50, your balance is now $0. We don't go back to the income statement. When this liability or this credit card gets paid, it's going to come out of our assets. So we had to have some kind of cash, or God forbid, I hope we not balance transferring, or maybe we got a loan. Wherever we got the cash from, it does not matter. But I need for you to understand that these financial statements that you're getting, this kind of looks like a football play. But these financial statements that you get, they are not just nice things that your accountant gives you so that you know that she's working. These are things that we give you so that you can manage your business. Now, we're going to take a deeper dive into the income statement in an upcoming video, and we're going to take another dive into the balance sheet and make sure we understand it. But the point of today was credit cards. We could not talk about credit cards without talking about the income statement and without talking about the balance sheet. Okay, someone has a question, but I'm not recording this live. I made a mistake or two, but I'm not going to go back and fix it. It's going to be all right. I told you all things factual. um, Nevertheless, remember, you spend money on a credit card. What's going to happen? You just increased your expenses and you increased your liability. Something happened on the income statement, something happened on the balance sheet. When you go to pay that credit card statement, everything happens on the balance sheet. You know what happens? Your cash asset go down and your liability goes down. Liabilities going down is a good thing. Cash going down, not always a good thing. In accounting, there has to be two sides to everything. Personal credit cards. A lot of folks are using personal credit cards because you may get better rewards and things on these personal credit cards. So you decide to use your personal credit card instead of your business credit card. If you are doing this, you need to remember at the end of each month, you need to give your accountant a clearly defined list of the things that were business and the things that were personal. If we only have access to your business accounts, there's no way for us to know what you did on that personal credit card statement. So you know what happens? That expense never gets here. This net income is too high, and that tax bill is too high. So if you are using credit cards, be sure. Now, if it's a personal credit card, we don't want login, we don't want access. We need for you to download it, get it to us, highlight that which is business, and make sure we get it. Okay? Um, Income statements and balance sheet. There's going to be a test. No, there's only a test for people that we work with on a monthly basis. But we're going to take a deeper dive. So if anyone has any questions, and I really expect to see some questions on this one because I've been talking about it a lot all week and I've been answering a lot of questions. And I know that it is a little bit tricky, and I hope I did the explanation justice. So I expect to see questions. One question that I don't know why I can hear somebody thinking, what if I bought something on my credit card in December, but I didn't pay the bill until January? Do I just deduct it next year when I pay the credit card bill? No, no, no. The minute you use that credit card, you incurred that expense and you can deduct that expense. That's the same for medical expenses. It's the same for tuition expenses, even if it's paid on a credit card. Now, the flip side is if you deduct this, well, when you deduct this expense in the year that it was incurred, you also, when you go to pay this credit card bill, if you pay it in the next year, that's not a deduction because remember, when you pay this credit card bill, this liability, it's on your balance sheet. So your liabilities go down and your assets, your cash asset is going to go down. So if you are getting ready to get your taxes done, we are accepting new clients in all 50 states. We do home daycares, we do center daycares, we do group daycares. We do some preschools and we do nonprofits as well. If you are preparing to have your tax returns done, make sure you go through these credit card statements. Make sure you hit Amazon statements. We love Amazon, right? Make sure you hit your inbox and you check for things that may have been ordered on other credit cards and such because you will miss these deductions. If you're a cash basis taxpayer, meaning that you pay taxes when the income is received or when the expense is actually incurred, and you have 2019 credit card expenses, these 2019 credit card expenses need to be deducted on your 2019 tax return. If you forget them, it's not an option to deduct them when you pay the liability in the next year. What's going to happen is you will have to go back and amend that tax return. Now, we do amended tax returns as well, but we like to do everything efficiently, accurately the first time. So if you fall into one of these situations, just remember the sound of my voice. And my kids tell me that it's unforgettable and it's annoying, but just remember the sound of my voice with the credit cards, okay? Liabilities account, it's a liability account. It lives on your balance sheet. The expenses from them live on your income statement, your profit and loss, your P&L, statement of cash, income and disbursements, or receipts and disbursements, or whatever it is that you call it in that day. Two basic financial statements. Thank you for your attention. I appreciate it. I appreciate all your support. If you have questions, go ahead and drop them below. If you would like to reach us, the easiest way to get in contact with us is by emailing team@jonestaxesonline.com or hitting us in the inbox, but inboxes will be delayed a little bit during tax season because I don't allow anybody to manage my Facebook profile. So thank you for your attention. I sincerely appreciate you, and I look forward to speaking with you in the next video.